Today, we're about to witness some of the most worrisome banking crises ever. The United States will soon record one of the worst failures of a U.S. bank since the global financial crisis. The financial sector has undergone a serious upheaval in recent weeks, with several banks on the verge of bankruptcy. At this moment, 4 banks have already failed, and a 5th is experiencing worsening financial conditions. This begs the question, what is happening with banks, and why are they collapsing? And should we actually be worried about an incoming bank crisis? Before we jump in, please make sure you like and subscribe to help no-cap capitalists keep producing more content for you. Thanks. Now on with the video. The failure of Silicon Valley Bank and Signature Bank will now go down in the history books as an example of bank runs, which occur when too many depositors remove their money from a bank at once. The cause might be a more serious issue, highlighting flaws in the American banking system and focusing on record inflation, dubious balance sheets, and rising rates. According to Martin Grunberg, the head of the Federal Deposit Insurance Corporation, the U.S. financial system is over $620 billion in risk. By Sunday, there had been a significant showdown between 3 banks, with Silvergate Capital Corporation becoming the 3rd to fail. When interest rates rise quickly over a short period of time, a bank is exposed to interest rate risk. This is exactly what is happening in the U.S., where the Federal Reserve has been aggressively raising interest rates since March 2022. The federal government has thus far raised interest rates by 4.5% in an effort to curb inflation. This led to an equivalent rate increase. According to the AP, the yield on U.S. government Treasury notes with a 1-year maturity reached a 17-year high of 5.25% in March 2023, up from less than 0.5% at the start of 2022. The 30-year Treasury yield has increased by approximately 2%. As a result, the price of securities starts to decline as the yield increases. The market value of previously issued debt, such as corporate bonds or government treasury bills, plummets when rates climb so quickly and in such a short period of time, especially for debt with longer maturities. According to an AP explanation story, a 2% increase in a 30-year bond's yield, for instance, can result in a 32% decline in the bond's market value. As long as the owner can hang on to the security till its due date, at which point it is going to be able to retrieve the initial sum without suffering any loss, interest rate risk that causes a decrease in the market value of a security is not a major issue. The only deficits will remain undetected on the bank's balance sheet and eventually vanish. However, the unrealized loss turns into an actual loss if the owner is forced to sell the security before it matures at the same time as the market value is less than the security's actual face value. In order to deal with their own cash shortages, the Silicon Valley Bank started withdrawing deposits at a time when interest rates were high, which led to a major confrontation. The ability of regulators to take effective action to safeguard banks and customers is even being called into serious question in light of this. The showdown occurred when SVB clients began withdrawing deposits in amounts greater than the bank could cover with its cash reserves. As a result, the bank made the difficult decision to sell $21 billion of its securities portfolio at a $1.8 billion loss in order to meet its obligations. According to the AP story, the lender attempted to raise almost $2 billion in new capital as a result of this drain on equity. Customers of SVB, who were already beginning to lose faith in the bank, were alarmed by the request to raise equity and raced to withdraw funds. Such an attempt can cause even a strong independent bank to go bankrupt in a matter of days in the modern world. Due to the Fed's rate hiking program, all banks currently have some of their assets exposed to interest rate risk. The U.S. government's decision to guarantee all SVB and Signature Bank deposits, irrespective of the size of those deposits, could reduce the likelihood that a bank with less cash and more securities on its books will experience a liquidity constraint as a result of large withdrawals sparked by an unexpected panic. On March 10th, a major lender to the technology sector fell victim to a typical bank run, marking the worst bankruptcy of a U.S. bank since the global financial crisis. Before U.S. regulators interfered to take control, Silicon Valley Bank's clients were hastily withdrawing their money from the California-based lender. The collapse, however, frightened the markets and added to the agony being felt by weaker financial institutions that were already dealing with the unforeseen effects of skyrocketing interest rates and self-inflicted pain. A week later, First Republic Bank was the first significant threat to a bank of global financial prominence since 2008. However, coming back from the brink was as a result of the central banks who serve as lenders of last resort and some of the sector's most powerful players providing enormous amounts of emergency liquidity. By the way, please remember to like, subscribe, and comment. Since the end of trade on Wednesday, benchmark indices of shares in the U.S. and European banks have fallen by 20% and 13% respectively. SVB was taken over by the Federal Deposit Insurance Corporation of the U.S. government. Since Washington Mutual, it was the largest banking collapse in American history. The bank had suffered a multi-billion-dollar loss when it sold U.S. government bonds to raise cash to pay depositors, which set the wheels in motion 48 hours earlier. It attempted but failed to raise money by selling shares. That started the hysteria that ultimately brought it to an end. Following a run on its accounts by clients alarmed by the collapse of SVB, the FDIC closed down Signature Bank. Unusually high proportions of uninsured deposits were used by both banks to finance their operations. On March 15th, following a 30% share price decline at Credit Suisse, Swiss authorities declared a backstop for the second-largest bank in the nation. The immediate market panic was soothed, but the global player is still in trouble. Customers and investors are concerned that it has a convincing plan to stop a steady decline in business. Customers withdrew their deposits, putting First Republic Bank in danger. The CEO of America's largest bank, Jamie Dimon, and U.S. Treasury Secretary Janet Yellen developed preparations for a private sector bailout during a meeting in Washington. As a result, First Republic and a consortium of American lenders came to an arrangement to put tens of billions of dollars in cash into the company in order to stop the bleeding. In a crisis rescue plan intended to calm the financial markets, UBS, the largest bank in Switzerland, agreed to purchase its struggling rival Credit Suisse. More than $400 billion has been invested directly to date. The U.S. Federal Reserve has committed to insuring all deposits at Silicon Valley Bank and Signature Bank for a total of $140 billion. Then there are the emergency loans totaling $54 billion that the Swiss National Bank provided to Credit Suisse and the loans totaling 209 billion Swiss francs that the Swiss government insured and provided to UBS as security against possible losses. Additionally, the Fed approved record-high loan amounts to other banks last week. In recent days, banks borrowed roughly $153 billion from the Fed, shattering the previous record of $112 billion established during the 2008 financial crisis. At this point, banks drew on nearly $12 billion in loans through the Fed's brand-new emergency lending program, which was launched at the beginning of the week in an effort to save more banks from going under. The entire amount of $318 billion that the Fed has lent to the financial system is less than half of what was done during the world financial crisis. In the long run, the banking sector has coughed up billions. A group of 11 lenders, including J.P. Morgan Chase, Bank of America, and Citigroup, are giving the $30 billion liquidity injection to boost trust in First Republic Bank. According to reports, HSBC has invested almost $2 billion in SVB's UK operation, which it purchased on Sunday for £1. But what will happen to the money of customers if US Bank collapses? Thank you for watching. If you enjoyed this video, make sure you click the like and subscribe buttons. Most importantly, don't forget to click the bell icon to be notified when a new video is uploaded. Also, feel free to leave a remark if you have any recommendations for videos. From No Cap Capitalist, have a great day, and thanks once again.